Good afternoon and welcome to Real Talk Economics, the August edition. My name is Markus Kuger and I'm the Chief Economic Advisor at Baker Ring. We are a global accounts receivables management company. We're more than halfway through the year and a lot of professional forecasters and institutions are releasing mid-year economic updates. They are checking if their 2025 growth projections are still in line with reality. And I want to spend a few minutes today to have a look at the latest IMF forecasts. Let me bring the slides up to show you the agenda. I want to start with macroeconomic conditions. A lot of indicators at the moment are actually improving. That's good news. Geopolitical developments are also not as bad as they were 3 months ago, 4 months ago, so that is certainly helping. Unfortunately, credit risk remains an issue. We will come to that later. And as said, the special topic today is the latest IMF set of forecasts. They do that on a quarterly basis, and the latest edition has just been released in July. And without giving too much away, right at the beginning, forecasts have actually been revised upwards, at least when we compare it against the April forecast. The last chapter is Q&A. If you have questions, please use the comments function here on LinkedIn, and I will address your questions towards the end of the presentation. One has actually been submitted a few days in advance on LinkedIn. Please feel free to do that for the next Real Talk Economic session before I forget to tell you. It will take place, as always, first Wednesday of the month. I think it is the 3rd of September, 12:30 UK time, 1:30 continental European time. Let's have a look at macroeconomics. And as I said, generally the picture has improved since we've last met. Some things haven't changed though. One of them is the US dollar. The US dollar is still substantially down against the euro, not only against the euro, against other currencies as well. Against the euro, it is down by around 6% year on year. A lot of that depreciation has happened in spring, March, April, when Donald Trump scared markets with his tariff announcements. Not all of these tariffs were eventually implemented, but it has certainly spooked markets, and the dollar is down by around 6%. That hasn't changed over the past few weeks and months. When we look at stock markets, we can also see the effect of that Liberation Day, it was called, by the American administration in April. We're seeing a massive drop in share prices. We're looking at the S&P 500 here, so Wall Street, US stock market. But since then, it has completely recovered, and it had actually reached a new all-time high last week. Since then, it has moved a bit lower. But when I created the slides a few days ago, the S&P 500 was up by more than 14%. In Europe, similar story to a varying degree. In Germany, the improvement in the stock market indices is even higher. We're looking at the DAX here, which captures the 40 biggest German stock-listed companies. And that obviously collapsed as well in April, but has since then made up for these losses. In a year-on-year comparison, it is up by more than 34%. In the UK, the FTSE 100 is also up by 12%. So global share prices, they have generally recovered from that shock that was seen in April, and they're up in a year-on-year comparison as well. So good news from stock markets. Let's change the topic and look at consumer confidence. And we start with the US. It is the biggest market, and I haven't used this slide before, or this graphic. I came across it during my research for today's webinar, and I thought it highlights very nicely the problems that people are facing that conduct surveys. Because not only is it more difficult these days to find people who want to participate in surveys, survey response rates have dropped immensely, especially since COVID, but there is also a problem with political bias. What are we looking at here? We're looking at consumer sentiment, but it is broken down by party affiliation for the US. The green line represents Democratic voters. The black dotted line represents Republican voters, and the blue line represents independent voters. The good news is that, generally speaking, consumer confidence in the US has improved for the first time in 6 months. So that is the good news. But look at the data. There are different developments depending on which political group you're looking at. And they're completely at odds with the most recent trends. So look at the green line. Democratic voters were very, very confident about their situation between 2020 and 2024, while Republicans were very pessimistic. Since the beginning of 2025, that has changed completely. So what's the driver behind that? Well, it is because of political bias. Democratic voters, they were tempted to answer survey questions about confidence in a very positive way when Joe Biden was in charge. Republican voters, the opposite. They were very pessimistic, although their situation might have been very different. They might have been employed, their wage growth might have been substantial, yet they still didn't want to admit that the government's doing a good job. And now we have the reverse situation. The Democratic government has been replaced by the Trump administration. So Republican voters, they are saying that the situation is great, that they're very confident, and Democratic voters have become super pessimistic. So that's a problem for companies or institutions that conduct surveys. This is actually from the University of Michigan, because you need to make sure that your sample is good. If Republican voters are overrepresented, you end up with a very positive consumer confidence index. If Democratic voters are overrepresented, you end up with a very negative consumer confidence reading. And a year ago, it would have been completely opposite situation. So political bias is making it more complicated to collect data that is meaningful. But then when you want to rely on hard data, on data that is collected by national statistics offices, for example, that's becoming an increasing issue as well. A lot of these agencies, they have faced cuts either in real terms because inflation was so high in 2022 and 2023, or because of nominal cuts. In fact, the US administration, they are conducting severe cuts to statistic agencies. And Donald Trump has actually just last week fired the head of the Bureau for Labor Statistics because he wasn't happy with the data. So I leave it to you to decide whether that is helpful when it comes to reliability of data. So the important bit here is that the situation is very diverse depending on which person you're asking. But the general trend, at least last month in the US, was that consumer confidence has risen, which is good news given the importance of US consumption for the global economy. When we look at the EU, unfortunately, the situation is slightly different. EU consumer confidence has fallen. We had seen a continuous improvement between mid-2022 and Q3 2024. In fact, mid-2022 was an all-time low when it came to consumer confidence in the EU. Then 2-year-long improvement. Since then, the situation has slightly deteriorated. So that isn't particularly good news for the B2C market in the EU. And when we look at the UK, it is a very similar picture. Here we can see the UK consumer confidence reading between June 2024 and June 2025. And you can see it has been moving sideways more or less for half a year, for 9 months. The latest data point isn't included because it has just been released after I had prepared the slides. In July, we've seen a marginal deterioration again. It dropped by 1 point. So again, consumer confidence in the UK subdued compared with a year ago, but certainly up from these readings that we've seen 2 years ago and 3 years ago. The problem with the UK is that household savings rates are still very, very high. That started during COVID. It wasn't voluntarily. Households couldn't spend their money, couldn't go on vacation, couldn't go to a restaurant, lockdowns were in place. And unfortunately, this hasn't changed, which obviously means that spending power is curtailed. Let's look at business confidence here. And business confidence, very similar story. generally speaking, things are improving. Not in all geographies, not in all sectors, but generally things are looking good. My warning light just flashes. The connection seems to be bad, which seems to be a recurring topic in the German countryside. I hope it won't break like last month. Fingers crossed. So I continue talking. If I lose connection, please drop it into the comments function. I will reconnect in that case. Let's start with the US again. In the US, consumer confidence has been improving. Business confidence has also been improving. And we can see that by looking at the Composite PMI output index. What does that mean? Well, first of all, PMI, Purchasing Managers Index, widely used index amongst us economists. It gets created monthly and allows comparison across time, across sectors, across geographies. Composite means we're looking at a combination of the manufacturing sector as well as the service sector. The PMI range is between 0, which is the worst reading, to 100. 100 is the best reading, which makes 50 the neutral line. Readings above 50 are good. Readings below 50 are bad. And in the US, the index has improved from around 53 points in June to now 54.6 points. It is actually the best reading in 7 months. So that is encouraging news. In the Eurozone, similar development, even better if you want to approach it from this is an 11-month high. The current reading is basically, it hasn't been that high in almost a year. But then when you look at the actual reading, you see 51 points. That's not spectacular. That is fairly close to that neutral line. So in the Eurozone, things are not that great from a business confidence perspective, but they're still better than a few months ago. So that is the good news. In the UK, same reading as in the Eurozone, 51 points. But in fact, in the UK, we've seen a marginal deterioration. The current reading is now on a 2-month low. The improvement that we've seen in the US, that we've seen in the Eurozone, was mainly driven by the service industry. When we look at global manufacturing PMI, that has actually fallen last month, and it has actually fallen below that neutral 50 points threshold. We are now at 49.7 points. And while Asian economies were still doing okay from a manufacturing perspective, the likes of Canada, Mexico, most EU countries, especially Poland, they have seen sizable deterioration in their industrial sector. On the left-hand side, you can see global business activity expectations. Basically, the question is, how confident are you that the next 12 months are better than the last 12 months? And we are comparing the current readings with the readings at the beginning of the year. And we can see that, generally speaking, survey respondents have become a bit more pessimistic, but nonetheless, the overwhelming majority of survey respondents still expects the future to be better than the past. Could have something to do with widespread optimism and the nature of business leaders, but generally, I think that is a good sign. We're still in a situation where businesses expect the next 12 months to be better than the last 12 months. Moving away from these confidence indicators, let's look at inflation. And inflation is becoming a bit of an issue again, at least when we look at the UK. In the UK, inflation is now on the highest reading since January 2024, which is quite disturbing. CPI, consumer price inflation, is up from 3.4% in May to 3.6% in June. And CPIH, the H stands for housing costs, there's a housing cost component included in that. That's even higher. That's now on 4.1%. So depending on which inflation measurement you want to use, we are around twice as high as the inflation target of the Bank of England, which is 2%. Inflation continues to be driven by the service sector. Service sector inflation is much higher in the UK. That applies to other geographies as well, by the way, but let's focus on the UK here. Service sector inflation in the UK, 5.2%. But there is an issue with goods inflation. Goods inflation was much lower a year ago, 6 months ago, close to 1%, and that has been creeping upwards. It's now on 2.4%. So that gap between service sector inflation and goods inflation is certainly narrowing. In the Eurozone, inflation is bang on target. 2%. The ECB's inflation target. That's exactly the figure for the Eurozone. So mission accomplished. In the US, worse than in the Eurozone, but better than in the UK, and on a deteriorating trend, unfortunately. US inflation in June, 2.6%. Not that high, especially not when we compare it with those readings in 2022, 2023. Inflation was spiraling out of control back then. So we're far away from that, but inflation is now on 2.6% in the UK. In the US, it was on 2.4% in May. It was on 2.3% in April. So it has been creeping upwards. We can't really see the effects of tariffs at the moment, at least to a large degree. They are not there yet, but that could be temporary. A lot of economists expect these tariffs to have a bigger impact on US inflation in the second half of the year, and that's because of two developments. The first one was that American companies stockpiled goods at the beginning of the year. They wanted to beat the tariffs. They imported a lot of stuff from abroad, especially from China, and now these inventories are depleted. So companies will have to face the higher import costs. The second reason was that there was so much uncertainty around tariffs in the US. Yes, they were announced in April, but it was clear that they will be renegotiated. So companies in the US were fairly reluctant to change prices. They didn't want to scare buyers. So now trade deals have been signed. There is more certainty about tariffs, and companies can now recalculate their pricings in the US. So most economists, and I think that assumption is a fair assumption, expect a bigger impact of tariffs on US inflation in the second half of the year. Closely connected to inflation is interest rate, of course. Interest rates are falling, but they're still on a fairly high level when we compare it with 5 years ago, 10 years ago. Inflation has come down. I told you that we're nowhere near these levels that we've seen 3 years ago, 2 years ago, and central banks around the globe have cut interest rates. Others, some more aggressively than others. For example, in the UK, interest rates have come down by 100 basis points to now 4.25%. In the Eurozone, the ECB was much more aggressive. Interest rates were cut from 3.75% to 2%. And markets still expect further cuts in the second half of the year. For the UK, markets are pricing in 25 to 50 basis point cut. So one interest rate cut or two interest rate cuts. There are downside risks. I told you that goods inflation is moving higher. Inflation is on the highest reading since January 2024. But nonetheless, given the state of the economy, given the fact that a lot of these inflationary pressures are temporary, I think the Bank of England will cut rates later this year. But as we can see from the chart here on the left-hand side, interest rates are still high. What are we looking at on the left-hand side? We're looking at the interest rate on new loans to PNFC in the UK. PNFC, private non-financial corporations. So basically the private sector in the UK. And you can see, yes, it's coming down, but it is still very, very elevated. I tried to make my presentation today a bit more optimistic than previous ones. So if you look long enough, you find bright spots, even in interest rate data and central bank related news. And one of them is actually the Credit Conditions Index. It's a quarterly publication issued by the Bank of England. And when you look at the Q2 report, you can actually see that commercial banks expect credit supply to increase in the second half of this year, which basically means that access to credit should become a bit easier for companies with positive ramifications on credit risk. Labor market, last month we looked at UK data, so I thought this month we look at EU and Eurozone data. Story is fairly similar. Unemployment isn't an issue in the EU, isn't an issue in the UK either, although there it has been trending upwards again slightly, but we're still much lower than in the Eurozone and in the EU, around about 4%, which is close to full employment. In the EU, unemployment has been falling for more than a decade, quickly interrupted by COVID, but the general trend is positive. Has something to do with demographics, of course, as well. But the current unemployment rate in Europe, Eurozone, EU, is the lowest on record. So never ever before, since the start of the data series, I think 20, 25 years ago, has unemployment in the EU been so low as it is now. That doesn't mean that everything's fine when we look at the labor market. And if you joined last month and the previous month, you know what the next slide will show, because it will show you job vacancies. Because there are certainly indicators that show a slowdown in the labor market. It's not that visible in unemployment, but it is certainly visible when we look at vacancies. Vacancies dropped during COVID. Of course, nobody needed employees then. Everything was locked down. And then we had this massive spike in the immediate aftermath, new all-time highs. But then for the past 2-3 years, job vacancy rates have been falling. In the UK, they're actually now lower than they were before COVID. And at the moment, we seem to have a problem with getting young graduates into work. So people that leave university, that leave higher education, they struggle to find jobs at the moment. At least that's what the data is showing, which is fairly unusual, because normally the higher the education, the easier it is to find a job. Could have something to do with AI being implemented. It's too early to find out what the main driver is, but it is certainly visible that a lot of these entry positions for university graduates, they're not there anymore, at least not to a degree. So yeah, job vacancies still an issue, but the general state of the labor market is still okay, although gradually deteriorating. So that was my final comment about macroeconomics, at least for a few minutes, because you've probably realized we haven't talked about real GDP, which is my favorite indicator. I'm an economist, so I can't present to you without talking about real GDP growth forecasts. We'll come to that when we speak about the latest set of IMF forecasts. But let's look at geopolitical events first. And similar to the macroeconomic story that I've just told you, things are currently improving, which is good news. The economic policy uncertainty index is finally coming down. For those of you unfamiliar with that metric, it's basically measuring certain keywords in newspaper headlines, major newspaper headlines around the globe. And you can see that we had a spike during COVID 2020, things improved, and then Donald Trump was re-elected and that index hit a new all-time high. But for the past few weeks and months, the situation has actually improved again. And we can see a similar situation when we look at the trade policy uncertainty index. Same logic. We're looking at trade policy related keywords now, of course. Spike during COVID, not that much, 2020. Then no problems for the next few years. And then Donald Trump gets elected, and in April, this index explodes. And now it's back to a much lower level, but you can also see it is still elevated compared with a year ago, compared with 4 years ago or so. And this is a story that you should keep in mind when I finish my presentation, that yes, things are improving, but things are improving compared with 3 months ago. They're not necessarily improving compared against last year. Uncertainty is still much higher than a year ago. Economic growth, and we'll come to that later, is not that great as well. Just because things aren't as bad as we had anticipated in April doesn't mean that the situation is great. Another area where we've seen some improvement is the world of logistics. Shipping costs have normalized again. You might remember this chart from last month. I've updated it, and it's showing further improvement. Here we're looking at shipping costs for a 40-foot equivalent unit, so basically a shipping container from Shanghai to other ports. And you see these two massive spikes a few months ago. That's when shipping costs from Shanghai to New York and from Shanghai to Los Angeles exploded. And that was related to a story that I already told you 20 minutes ago or so. That was caused by American companies stockpiling goods, trying to get as many input products into the country to beat the tariffs. And because there was a shortage of shipping vessels and containers, that drove prices up. Now we have more certainty, more clarity. So we've seen a moderation in shipping costs. That doesn't mean that there are no issues with global supply chains. There's still a civil war in Yemen, which is basically having significant ramifications on Suez Canal traffic. There's still a water shortage in the Panama Canal. There's still a shortage of workers in the logistics sector. So it doesn't mean that everything's fine, but at least when we look at container shipping costs, the situation has normalized. Next chapter, credit risk. And as said, I tried to be positive when we talked about macroeconomics and geopolitical events. When I talk about credit risk, the picture is bleaker. And that has also something to do with the fact that we haven't really had a lot of new data releases since last time. That's especially true for the EU. In England and Wales, situation is, I'd say, mixed. We had an improvement last year. Last year, the number of business failures in England and Wales dropped by 5%, but we have to keep in mind that it dropped from a 30-year high in 2023. So 5% improvement, but 5% improvement from an incredibly high level. When we look at the data points that exist for 2025, which is up until June, we can see stagnation effectively. If you aggregate the monthly figures, you end up with around 12,500 business failures this year. And when I calculated everything in my Excel spreadsheet this week, the difference was actually 4 insolvencies. I forgot if in the first half of 2025 we had 4 more insolvencies than in the first half of 2024 or the other way around. But generally speaking, 12,500 insolvencies in the first half of the year. Nothing has changed compared last year. In the EU, different story to a certain degree. Last year, another deterioration, 4% increase in the number of business failures. When we look at the 3 major markets, Germany, France, Italy, double-digit increases in business failures. But in Q1, we've seen a drop by 1.5%. So that's the good news. The bad news is that we're still waiting for Q2 data. It hasn't been released by Eurostat yet. So at the moment, it's not possible to say whether this positive trend has lasted into the second quarter of the year. What's the outlook for insolvencies for the rest of 2025 and going into next year? Generally speaking, this is data from Allianz Trade. They publish a global insolvency index twice a year, I believe. And their latest report shows that last year, we've seen an increase by 10%. So England and Wales was an outlier. On global scale, figures went up from an insolvency perspective. And unfortunately, the index is now 10 to 15% above the pre-COVID average. So we are now on a more elevated level. Looking ahead, yes, interest rates will come down. I've shown you on the interest rate chart, but at the same time, they're coming down from a fairly high level. Companies have still not fully digested the energy price shock a few years ago. Companies are still in a position where they have to repay COVID loans. Households are quite reluctant to spend on big ticket items because of the huge level of uncertainty. So I think Allianz Trade's forecast of another 6% in increase of the global insolvency index is a fair assumption. And for next year, they assume that figures will deteriorate further, another 3% increase. So credit risk, insolvency risk will remain elevated. Payments performance, similar story, because we haven't had a data update. We're still waiting for Q2 data from Dun & Bradstreet and its worldwide network partners. So we have to rely on Q1 assessment. And that wasn't a good one. If you remember last month, well, maybe let's take back a step. 2024, not a lot of change in average payment delays in Europe. The year started with an average payment delay beyond agreed terms, that is, of 12.1 days, and it finished the year on 12.2 days. So yeah, not a lot of change, but a slight deterioration. So the wrong direction of travel. The first quarter of 2025 has seen a very sizable deterioration, though. The average payment delay increased from 12.2 days to now 12.7 days. I've been using that data for more than 15 years now, and it's quite unusual to see such a big change. Normally, changes are 0.1, 0.2 days, 0.5 days within a quarter is not common. One of the worst performers in Q1 was the UK. Average payment delays in the UK increased from 10.8 days to now 12.2 days, but the UK is still better than the European average. And that is something that has only been the case for the past, I think, 2, 3, 4 quarters. A year ago, 2 years ago, UK payment delays were worse than the European average. So the UK had a very good 2024 and a very good 2023 as well. A country that didn't have a good performance over the past few years is France. If you tune in regularly, you know what's coming. But I think it is fair to warn people with exposure to France. France has been on a very poor trajectory over the past few years. Since COVID, the average payment delay in France has risen by more than 5 days, 17.7 days beyond agree terms now. When I started using that data series in 2010, France was the third best country in Europe. It was never as good as Germany and the Netherlands, but not far off. And now, over the past 5 years, we've seen sizable delays in payment. And now France is in that Mediterranean league with Spain, Italy, and only Portugal pays slower when we measure it in delays beyond agreed terms. And that is not only something that we are seeing in the Dun & Bradstreet data, it's also something that the proprietary Baker Ring data is showing. There's a lot of demand for our services assisting in collecting overdue invoices in France. We've hired a lot of French-speaking credit managers recently. So yeah, France is certainly a country to watch. Unfortunately, from a macroeconomic perspective, positively, obviously, for Baker Ring, that is good news. Last chapter of the day before we reach Q&A is the World Economic Outlook update that the IMF has released a few weeks ago. 4 times a year, the IMF updates its forecasts. And as mentioned previously, there is good news. Compared with the April edition of the World Economic Outlook, the International Monetary Fund has revised forecasts upwards. Global growth, that's that light blue box here on the left-hand side, is now expected to come in at 3%. In April, the fund had projected 2.8%. So from 2.8% to 3%, and next year, instead of 3%, the fund now expects 3.1% growth. So good news. The US has seen an upgrade, 1.9 instead of 1.8% this year, and next year 2% instead of 1.7. That was the forecast from April. So upgrades. China has benefited as well. In April, the IMF had forecasted 4% growth for 2025. Now it's forecasting 4.8%. So very, very sizable, 0.8 percentage points. The UK and the Eurozone, smaller improvements, nonetheless, improvements as well. What has driven this upgrade over the past 3 months? Well, first of all, there has been a lot of economic activity in the first quarter of the year. A lot of companies have front-loaded stuff, and that will have an effect on economic growth until the end of the year. So that was beneficial. The dollar is weaker than expected, which helps. Energy prices are also weaker, so that helps. Although the IMF has changed its energy price forecast for 2025, they now expect 7% decrease in energy prices. It was higher. They expected a bigger drop in the April version, so that isn't great news, especially from an inflation perspective. And then the biggest driver, obviously, was that trade war that was widely anticipated in April. It didn't come, at least not to the degree that seemed possible in April. So tariffs are not as high as initially feared, and we'll come to that on the next slide. And there's another driver for why growth forecasts have been revised upwards, and that is fiscal policy. A lot of governments at the moment are spending a lot of money, and that is also supporting growth. So things are getting better. That's the good news. But now, as always, comes the but. So things are getting better, but they're only getting better when we compare it against April. When we compare it against January, things are not getting better. In fact, in April, global growth forecast stood at 3.3%. Now it is 3%. So compared with the beginning of the year, the IMF has become more pessimistic about 2025. And we can also see that by looking at the chart here on the left-hand side, which shows the evolution of 2025 growth forecasts. So basically, you can see the growth forecast for certain countries during a certain point in time. And these points at the lower axis, they represent release dates of the World Economic Outlook. So look at the blue line, which is the US growth forecast for 2025. In January, the IMF had expected growth of around 2.7% for this year. Then this was lowered to 1.8, and now it has been lifted again to 1.9. So from 2.7 in January to 1.8 in April to now 1.9. So I leave that to you. Is that an improvement or is that a deterioration? It's an improvement against April. It's a deterioration against January. On the right-hand side, we see the evolution of tariffs. That's the blue line. The effective tariff rate on US imports briefly stood at around 24% in April. So very, very high, higher than in the last 100 years. And from 24%, it has now dropped to 16, 17%. It changes on a daily basis because the US is constantly changing tariffs, constantly negotiating trade deals. So from 24 to 17%, 16%, that's an improvement. But again, look at January 2025. Back then, the effective tariff rate was 2 to 3%. So again, tariffs are much higher than they were 12 months ago, but they're lower against April. So this is the positive news here. Quite cramped and overloaded chart, I have to admit here, especially on the left-hand side, but I thought I should speak about financial conditions as well in this presentation. This is also from the IMF's latest World Economic Outlook. On the left-hand side, we are seeing financial conditions. The trend here is downwards, which is good because it means financial conditions in these geographies are improving. Less stress in the financial sector basically means lending conditions should improve. Credit approval should go up. Access to credit should become easier. So that's the good news. The worrying bit is that chart in the middle, which shows yield curves. It shows the spread between a 30-year and a 10-year bond. And here things are going up, which basically means that governments have to pay more for the debt they're taking out. And governments are taking out a lot of loans at the moment. They're issuing a lot of government bonds. That makes it riskier to lend to governments. There are two trends at play here at the moment. In Europe, we see more government spending, military infrastructure, as agreed on during the latest NATO summit. 5% is the new target, up from, I think, was it 2? Yeah, 2%. So significantly up. Governments do not have the money, so they go to the bond markets and they issue more debt. In the US, it's not so much spending, it's revenues. The US government has cut taxes, and that has left a massive hole in government finances. So overall, debt is increasing. The debt servicing costs have gone up as well. Interest rates have gone up over the past few years. So that reduces the government's ability to take out these loans, and it also limits the room to maneuver. And that brings us to the next chart here on the right-hand side, which isn't from the IMF. It's actually from the World Bank. They've also released a mid-year update. Their report is more than 250 pages long, so I didn't really read it depth. I flicked through, and I thought this chart was quite interesting because it shows the investment climate in certain regions. EMDE stands for emerging markets and developing economies. LIC are low-income countries, so the poorest of the poor. And then on the right-hand side, the advanced economies. And as you can see, obviously the investment climate, the higher that chart is, the better the investment climate. And as no surprise here, advanced economies have a better investment climate than the not so developed markets. But the worrying trend here is that in all three groups, the investment climate has deteriorated in the past 12 years compared with the beginning of this century. And we're not factoring in what has happened since Donald Trump has returned to the White House. So it is becoming increasingly difficult for consumers, but mainly for companies to invest in the medium to long term. There's so much uncertainty. Yes, it has come down compared with April, but it is still up compared against a year ago. Where shall I build my next factory? Shall I build it in Spain? Shall I build it in Nigeria? Shall I build it in Texas? Very complicated decision because there's so many moving parts, and these trade relationships that had been in place for decades, they're now fragmenting very, very quickly, and things change overnight. Sometimes they change twice a day. I remember a few months ago when the tariff on Canadian steel imports to the US changed in the morning, and then it changed back in the afternoon. And it is pretty impossible to make long-term business plans in such an environment. So what are the key takeaways of today's presentation? And again, I want to be more optimistic than usual because, as I said, the data is improving. The second half of the year will probably be better than I had expected it to be a few weeks ago. So 2025 growth, 2026 growth has been revised upwards. There are still downside risks, but I'm a bit more optimistic than I was a few weeks ago. That's mainly because of the fact that the US effective tariff rate has come down from 24 to 17%. The UK isn't facing tariffs on many goods that are exported to the US. Not all of them are tariff-free though, but generally speaking, UK got a good deal. Europe's facing 15%. It's quite high. It used to be, I said, 2%, 3%. Now it's up to 15, but it could have been 30. And at least companies can now plan, at least in theory, because I wouldn't put any money on expecting that this trade deal will be in place until the end of Donald Trump's term. But let's be optimistic here. We have more certainty than we had a few months ago. Inflation in the Eurozone, bang on target, all good. In the UK, too high, highest reading since January 2024. In the US, creeping upwards again as well. And that is an issue because it means that central banks might not be in a position to cut interest rates as aggressively as required to stimulate the economy. But nonetheless, interest rates should come down in the second half of the year. But credit risk will remain elevated. We're still in a period of low growth, despite these recent upward revisions. Access to finance is getting easier in the UK. At least that's what commercial banks expect. But compared with a few years ago, it is still more challenging. Geopolitical risk remains elevated, maybe not as much as it was a month ago or 2 months ago, but it is still an environment where business leaders need to tread carefully. So yeah, conditions are still challenging. I hope I could have shed some light on some of these areas that you might be experiencing in your day-to-day job. If you need more help, I'd invite you to navigate to Bakering's Credit Hubs section. There's a lot of free of charge content on that homepage, from the macroeconomic geopolitical risk analysis that I've just presented to you, to sectoral reports. And for credit managers, the country fact sheets are probably quite interesting as well. They contain information about the legal environment in the country. They contain bullet points about collection practices. So yeah, if you haven't done so yet, please navigate to the Credit Hub section on bakering.global. Feel free to connect with me as well as Bakering on LinkedIn. You'd stay informed about new report releases. You'd stay informed about when the next Real Talk Economics session will take place. In fact, it's on the 3rd of September, after my summer holidays, 12:30 UK time, 1:30 continental Europe. And yeah, if you want me to cover certain topics because you find them interesting, please feel free to reach out to me either on LinkedIn or via the admin@bakering.global homepage. And yeah, as said, if you have questions, please use the comments function on LinkedIn. So far, nothing has come in today, but somebody has sent over a question previously. So that question was, and of course it's about tariffs, are tariffs creating economic benefits for the US as President Trump claims? There, as always, there's a short answer and there's a long answer. Let's give you the short answer first, of course, and the short answer is tariffs won't bring benefits to the American economy. That's at least what economic consensus is amongst pretty much every economist that isn't on the US government payroll. Tariffs are not increasing welfare on an overall level. Tariffs can help certain groups within a country, within a society, but the welfare losses are negative from a global perspective. They're certainly negative for the trading partners of the US, and even within the American society, they could be negative. They're very likely negative because there are not that many winners, and somebody has to pay these tariffs. Is it the foreign exporter? Is it Daimler-Benz or is it Rolls-Royce that's paying the tariff, or is it the American consumer? There are some signs that the American consumers will face higher prices. What we have seen, though, over the past few weeks is that tariff revenues have skyrocketed. And that's not a surprise. The tariff rate has increased from 2%, 3% to, well, first 24, now it's 17. But effectively, tariffs went up by factor 7. So it's not surprising that tariff revenue in the US has also gone up. So that is basically money that the US government can now reallocate to companies, to households, their decision. And as said, this is a new all-time high in terms of tariff revenues. But overall, it's a few $billion. It's not a lot of money given the overall size of the American economy. So I'd say that the benefits of implementing these tariffs are very, very limited, while the potential costs, not only from a geopolitical point of view, because you're alienating your allies, but also from an American economic cost perspective, they are so large that no government before him and no government in most other countries thinks that tariffs are a good idea. It could be that everyone's wrong and Donald Trump's right, or it could be, and I'm in that camp, that thinks tariffs are a bad idea. They create welfare losses and shouldn't be implemented on a large scale. You could shield certain sectors in your economy until they are competitive. It certainly probably made sense to put some tariffs on Chinese goods if they had been illegally subsidized by the communist government there. But generally speaking, tariffs are welfare destroying. So I'm not a fan of them, and many economists consider them as a bad idea. So no other question has come in today, which means I've probably answered all of your questions. I said, if you want me to cover a certain topic, if you want me to cover a question in the next Real Talk Economic session, 3rd of September, feel free to send it over on LinkedIn. Happy to cover it in more depth then. Until then, I hope you have a good summer holiday. If you haven't been on vacation yet, I will be off to Norway in 2 weeks. Looking forward to a bit of mountain hiking and swimming in the fjord. So until then, until September, have a good rest of your summer. Bye-bye.